Okay, imagine you borrowed 100 rupees from a friend to buy a tiny little piece of gold, and you promise to pay them back whatever that gold is worth in a few years. It sounds pretty fair, right? But then, suddenly, the global price of gold just totally quadruples. So what happens to your debt? Well, you don't owe 100 rupees anymore. You actually owe 400 rupees. That huge unexpected jump is exactly what happens when you link a promise to an asset that fluctuates in price. Now, I want you to imagine that exact same scenario, but instead of 100 rupees, we're talking about tens of thousands of crores, and instead of your friend, it's the government of India.
Welcome to this deep dive explainer. Let's just dive right into this, because today we are exploring a massive, hidden financial snowball, India's sovereign gold bonds. We're going to look at how a really brilliant, well-intentioned policy that was designed to solve a national crisis quietly grew into a financial exposure that is literally staggering in size, yet somehow completely invisible in the country's official budget documents. Here's how we're going to break this all down step by step today. First, we'll look at the golden deal, then move into the massive debt gap. Check out the missing safety net, uncover this crazy accounting blind spot, explore a changing global market, and finally wrap up with the big takeaway.
All right, kicking things off with Section 1, the Golden Deal. Was it a perfect win-win?
To really understand the situation we're in right now, we kind of have to rewind back to 2015 to see how this all started. See, back then, India had a major problem. The country was importing huge amounts of physical gold. We're talking up to 1,000 tons a year. And this was just draining the country's foreign exchange reserves and putting a ton of pressure on the national economy. So the government came up with a genuinely creative solution. They launched the sovereign gold bond scheme. The whole idea was super simple. Instead of importing physical gold from abroad, the government asked citizens to just buy paper gold directly from them. Between 2015 and 2024, they issued 67 different batches or tranches of these bonds. And now, this massive bill is going to come due, with a huge peak redemption period hitting between 2026 and 2032.
For everyday folks like us, ordinary citizens, taxpayers, small business owners, this was an absolute no-brainer of a deal. I mean, why buy physical jewelry or coins when you could get this? First off, it was backed by the sovereign government, so it was incredibly safe. Second, the government actually paid you a 2.5% annual interest rate just for holding on to it. Third, you didn't have to go rent a bank locker or worry about it getting stolen, so there was literally zero storage risk. And the cherry on top? If you held it until it matured, your capital gains were completely tax-free. Millions of Indian savers absolutely loved it, and the government actually succeeded in curbing those physical gold imports. Honestly, at the time, it looked like a total home run.
Moving on to Section 2, the massive debt gap, or what happens when prices completely skyrocket. Let's see how this snowball actually builds. Because while the scheme worked flawlessly in theory, the global price of gold came in and completely rewrote all the rules. Over the entire life of the scheme, the government raised a truly impressive amount of money from everyday savers. They collected a total of 72,274 crore rupees. Now, when they borrowed this money, gold was way cheaper, sitting around 2,600 to 4,000 rupees per gram on average. And the government took these funds and just used them like any other government borrowing to fund their everyday activities.
But here is where the math gets downright scary. See, the government promised to pay investors back at whatever the market price of gold happens to be on the day the bond matures, which means they took on literally all the risk of gold prices going up. And spoiler alert, gold prices didn't just go up, they absolutely skyrocketed. Today, that original 72,000-odd crore borrowing has ballooned into an estimated liability of 1.87 lakh crore rupees. Think about that for a second. The government owes 2.6 times more than what it originally raised, purely because the price of gold surged. That is a gap of roughly 1.15 lakh crore rupees just appearing out of thin air.
And this perfectly illustrates the core issue we're dealing with. Remember our little analogy from the very beginning? If you borrow 100 rupees from your friend, linked to the price of a gold ring, and that price quadruples, you owe 400 rupees. You don't just get to hand back the original 100. Well, the government is in that exact same boat right now. They borrowed 72,274 crore rupees linked to gold. The price surged, and now they owe a massive 1.87 lakh crore. It's a compounding debt driven entirely by something they have zero control over, global asset prices.
Which brings us to Section 3, the missing safety net. Basically, an empty savings jar.
You know how families usually set up an emergency savings jar for a rainy day when they take on a big financial risk? Well, when this scheme was launched, the designers actually did exactly that. They created something called the Gold Reserve Fund, or GRF. Just think of the GRF as a dedicated savings jar created specifically to absorb the risk of rising gold prices and to eventually pay for these bond redemptions. That way, the regular national budget wouldn't take a massive hit down the road.
But if we look at the numbers today, just how small has that jar become? When you compare it to that estimated liability of over 1.87 lakh crore rupees, the safety net is now just a tiny, tiny sliver. The gold reserve fund dropped to a mere 697 crore rupees in the latest budget estimate. That covers less than 0.4% of this massive debt. So that buffer, it's virtually gone.
All right, Section 4, the accounting blind spot, and how this true cost is somehow hiding in plain sight.
So if the debt has grown this astronomically large and the safety net is basically gone, why isn't this ballooning gap causing an absolute panic in official government documents? Well, this is arguably the most crucial thing to take away from this entire explainer. To understand government accounting, let's think about buying a house. Say you bought a house way back in 1990 for 10 lakh rupees. Today, in 2026, it's worth 50 lakh rupees. If you look at your finances using what we call historical cost, you just pretend the house and the loan tied to it is still only worth that original 10 lakh rupees. But if you use current market value, you acknowledge reality. It's a 50 lakh rupees situation. Historical cost is stuck in the past. Market value looks at the reality of today.
Now, the catch is that the Indian government's budget relies almost entirely on historical cost accounting. So when Parliament looks at the official budget documents, they just see the sovereign gold bond debt recorded at its historical issue price, roughly 67,322 crore rupees for the bonds that are currently outstanding. They simply do not see that 1.87 lakh crore rupee market reality. And what's really fascinating here is that the government's own accounting advisory board actually approved a modern standard, something called IGIS 10, that would actually force them to show the true current market value. But for whatever reason, that standard has never been officially notified. It hasn't been put into legal effect. So the true massive size of this debt just sits safely in a blind spot.
And this creates a really strange financial illusion, which I think is best explained like a quirky family business loop. Imagine you owe a massive debt that's linked to the price of gold. But your employer also pays you a yearly bonus that's linked to gold. So when gold goes up, your bonus goes up, making your bank account look incredibly healthy today, even though your silent, invisible debt in the background just doubled. This exact thing is happening on a national scale right now. Step 1. Gold prices rise globally. Step 2. The Reserve Bank of India, which holds hundreds of tons of physical gold in its vaults, sees its assets gain massive value. The RBI then pays a record-breaking dividend out to the government. Step 3. The government uses this dividend as revenue, which makes the national fiscal deficit look much smaller and super healthy. But simultaneously, that exact same gold price rise has secretly doubled the sovereign gold bond debt. The government looks richer on paper today, while a massive, unrecorded bill is just waiting for them in the future.
Let's pivot to Section 5, a changing global market, and the structural shift that got us here.
So why did gold go so crazy? Well, we have to realize that the world of 2015 is literally ancient history now. Gold didn't just fluctuate a little bit. The global market fundamentally shifted. Across the world today, gold is highly prized for its performance during times of crisis and the fact that it carries no default risk. Since the pandemic, and with geopolitical tensions rising everywhere, central banks globally, and especially China, have just been buying staggering, record amounts of gold. This massive buying spree isn't about short-term trading at all. It's a deep structural shift to diversify away from the US dollar. And this permanent change in market dynamics drove gold from around the $1,100 an ounce range when these bonds were first launched, all the way to the $2,300 plus range we're seeing today.
Now, to be completely fair and impartial here, there are very valid alternative views on this whole scheme. On the positive side, reasonable people and economists argued that the scheme was a completely necessary policy tool at the time. Back in 2015, it successfully curbed those out-of-control physical gold imports, stopped the drain on our foreign exchange, and really helped stabilize the currency. It solved a very real macroeconomic crisis. But on the flip side, financial experts raised some pretty severe concerns. They point out that while it solved the import problem then, it created a massive unhedged financial exposure for the future and really highlighted some serious accounting blind spots in how we track national debt.
Plus, there is this really interesting structural quirk built into the system, a bit of a conflict of interest, actually. See, the government owes tens of thousands of crores in debt, and the final payout to citizens is based on the domestic price of gold. However, the government is also the exact same entity that sets the import duties on gold coming into the country. Because India imports almost all of its gold, changing that import tax directly changes the domestic price. So the debtor,
The government essentially has the power to pull a lever, the import duty, that could artificially lower the price of its own debt right before they have to pay it out. Now, obviously, import duties are standard macroeconomic tools, but the lack of an independent firewall here definitely raises some really interesting governance questions.
All right, wrapping things up with Section 6, the big takeaway. Eventually, the math catches up.
So what does this all mean for us, the ordinary citizen, the taxpayer, the retail investor? The bottom line is this. First, that roughly 1.15 lakh rupee gap between what the government originally borrowed and what it now owes, that is very real. It is a massive unfunded liability. Second, our current historical cost accounting rules are actively obscuring this true fiscal cost from Parliament and the public. We are basically looking at outdated price tags. And third, financial transparency matters immensely. As the massive wave of these bonds reaches maturity between now and 2032, this bill isn't theoretical. It's going to have to be paid in actual cash.
The sovereign gold bond scheme was undoubtedly a bold, creative experiment. And hey, it worked perfectly for ordinary savers, and it solved a short-term import crisis. But we can't ignore that it also left behind a massive, unhedged financial legacy. Which leaves us with one final profound question to think about. What happens when a government hopes nobody does the math on a ballooning, invisible debt? It's a really vital lesson in public finance, and a pretty stark reminder that eventually, the math always catches up. Thank you so much for joining me on this deep dive explainer. Keep asking questions and always keep looking closely at the numbers.